What if your financial decisions are driven more by your emotions and past experiences than by logic or spreadsheets, leading to choices that feel right but derail your future? What if the difference between wealth and ruin lies not in how smart you are, but in how well you manage behaviors like greed, fear, or impatience? Morgan Housel's The Psychology of Money reveals that these hidden psychological traps cause many to mishandle their finances, from overspending to chasing risky bets. To overcome these pitfalls and build lasting wealth, readers must dive into this book to uncover timeless lessons on mastering the emotional side of money. Welcome, listener, to here are 18 wonderful lessons from the psychology of money. Lesson number 1. Recognize that nobody is crazy. People face incredibly different experiences with money, and what people experience is far more compelling than what they learn secondhand. Is it reasonable to expect people coming from different generations, growing up in different countries and family backgrounds, and born into different economies to show the same understanding of money? Picture this. A young man in a bustling city scratches off a lottery ticket, hoping for a life-changing win, while a wealthy investor across town scoffs at the idea, calling it a fool's gamble. To the investor, spending $400 a year on lottery tickets, especially when you're barely scraping by, seems utterly irrational. Yet, to the young man, that ticket represents a fleeting chance to escape a paycheck-to-paycheck existence, a dream of a better life that feels tantalizingly close. In The Psychology of Money, Morgan Housel opens with a powerful lesson. Nobody is crazy when it comes to money. Every financial decision, no matter how bizarre it appears, makes sense to the person making it, shaped by their unique experiences, upbringing, and view of the world. Housel begins by challenging our tendency to judge others' financial choices. Imagine two people. One grew up in poverty during the 1970s, when inflation skyrocketed and prices tripled, leaving them wary of spending and obsessed with saving. Another came of age in the late 1990s, when the stock market soared tenfold, fueling a belief that stocks are a sure bet. To the first, hoarding cash feels logical. To the second, pouring money into equities is obvious. Neither is wrong. They're just products of their environments. Housel cites a study by economists Ulrike Malmendier and Stefan Nagel, who analyzed 50 years of consumer finance data and found that people's investment habits are heavily influenced by the economic conditions of their youth. If you grew up with high inflation, you're less likely to trust bonds later in life. If you saw a booming stock market in your 20s, you're more likely to go all in on equities. These aren't random choices. They're rooted in lived realities. Take the example of lottery tickets, which Americans spend more on than movies, video games, and books combined. Housel notes that low-income households, those least able to afford it, spend an average of $412 a year on lotteries, 4 times more than high-income groups. To someone with a comfortable income, this seems reckless, especially since 40% of Americans can't cover a $400 emergency without borrowing. But Housel urges us to step into their shoes. For someone scraping by, with no hope of affording a nice home, a safe neighborhood, or college for their kids, a lottery ticket isn't just a bet. It's a tangible dream, a momentary escape from a world where opportunities feel out of reach. We're paying for a dream, Housel imagines them saying. And you may not understand that because you're already living a dream. It's not crazy. It's a rational response to their reality. Housel also draws on history to illustrate this point. He recounts a story from John F. Kennedy's 1960 presidential campaign, when a reporter asked what he remembered about the Great Depression. JFK's reply was stunning. I have no first-hand knowledge of the Depression. My family had one of the great fortunes of the world, and it was worth more than ever then. For JFK, the Depression was a distant concept, read about in books at Harvard. Meanwhile, millions of Americans carried the emotional scars of that era, joblessness, hunger, fear, shaping their distrust of banks and markets for decades. No wonder they clashed on economic policy. They lived in different worlds. Housel argues that our personal experiences, which make up just 0.0000001% of what's happened in the world, account for 80% of how we think the economy works. This explains why a stockbroker who lost everything in the 1930s might seem overly cautious to a tech worker riding the 1990s dot-com boom. Then there's the story of a Chinese worker's nephew. responding to a New York Times article about Foxconn's harsh factory conditions. Americans were outraged, but the nephew offered a different perspective. His aunt, who once worked as a prostitute, saw the factory's long hours and low pay as a step up. She'd rather be exploited by an evil capitalist boss for a couple of dollars than have her body exploited for pennies, he wrote. To Western readers, this might seem unfathomable, but to the aunt, it was progress. Her decision wasn't crazy. It was shaped by a world where survival meant making tough trade-offs. Housel's lesson isn't about excusing poor choices. Buying lottery tickets when you're broke or working in grueling conditions might not be optimal, but understanding why people make these choices bridges the gap between judgment and empathy. Financial decisions are made at the dinner table, not in a vacuum, influenced by personal histories, cultural norms, and economic realities. The investor who grew up in a stable economy might never grasp the desperation behind a lottery ticket, just as the factory worker's nephew can't fathom a life where such work isn't a step forward. Recognizing that nobody is crazy means accepting that we all navigate money through our own lenses, shaped by experiences as varied as the world itself. To truly understand money, Housel says, start by understanding people. Lesson number 2. Differentiate between luck and risk. In the shimmering haze of a Las Vegas casino, a gambler hits the jackpot, walking away with millions, while another, just a few tables over, loses everything on a single bad bet. One's hailed as a genius, the other a fool. But what if the line between their fates is thinner than we think? In The Psychology of Money, Morgan Housel's second lesson is a sobering reminder. Luck and risk are two sides of the same coin, silently shaping financial outcomes in ways we often refuse to admit. Success isn't always about skill, and failure isn't always about mistakes. Sometimes, it's just the roll of the dice. Housel kicks off with a story that feels like a modern fairy tale. Bill Gates, the tech titan behind Microsoft, wasn't just brilliant. He was extraordinarily lucky. In 1968, as a teenager, Gates attended Lakeside School, one of the only high schools in the world with access to a computer. This was no small thing. Computers were rare, clunky machines, and most universities didn't even have them. That access let Gates and his friend Paul Allen tinker, code, and dream, planting the seeds for Microsoft. But Housel introduces a shadow to this story. Kent Evans, another Lakeside student and Gates' close friend, was just as talented, just as driven. He, too, could have been a Microsoft co-founder, except he died in a mountaineering accident before graduating high school. Gates got the lucky break. Evans met a tragic risk. Their paths diverged not because of effort or intelligence, but because of forces beyond their control. Housel's point is sharp. Nothing is as good or as bad as it seems. Success and failure are rarely just about you. This interplay of luck and risk isn't just about tech billionaires. Housel zooms out to the broader financial world, where the same dynamic plays out daily. Consider the stock market. A single company, like Amazon, can drive massive returns for an index fund, but picking it early required not just insight but a dose of fortune. Most startups fail, and even the best investors can't predict every winner. Housel cites data showing that a tiny fraction of companies, less than 1%, account for most of the market's wealth creation. Betting on the right one is like catching lightning in a bottle. Meanwhile, risk lurks in every corner. A savvy investor might pour their life savings into a sure thing, only to watch it collapse in a market crash no one saw coming, like the 2008 financial crisis. The difference between triumph and ruin often hinges on events no one can control. Housel illustrates this with another pair, Cornelius Vanderbilt, the 19th century railroad magnate, and the thousands of investors who went bust chasing the same industry. Vanderbilt's wealth came from bold bets on railroads, but also from being in the right place at the right time, with connections and opportunities others lacked. Many who followed his lead, hoping to replicate his success, lost everything when the railroad bubble burst. Were they less skilled? Not necessarily, just less lucky and more exposed to risk. Housel argues that we're too quick to attribute success to brilliance and failure to incompetence, ignoring the invisible hands of chance. This lesson isn't about dismissing hard work or strategy. Gates was a coding prodigy, and Vanderbilt was a ruthless businessman. But Housel warns against judging outcomes solely on individual merit. If you idolize a billionaire's success without acknowledging their lucky breaks, you might take reckless risks to emulate them. If you scorn someone's failure without seeing the risks they faced, you miss the bigger picture. Housel suggests focusing on broad patterns, not extreme cases. Instead of chasing the next Microsoft, diversify your investments to increase your odds of catching a lucky break while cushioning against risk. Instead of beating yourself up for a loss, recognize that markets, like life, are chaotic. The gambler in Vegas who won big might feel like a genius, but he's not much different from the one who lost it all. Both face the same slot machine, the same odds. In money, as in life, luck can lift you to the stars, and risk can pull you under. Housel's lesson is a call to humility. Respect the role of chance, plan for the unexpected, and don't be fooled by the illusion that you control it all. Lesson number 3. It is never enough. The penthouse gleamed under Manhattan's skyline, its marble floors reflecting the glow of a chandelier that cost more than most people's cars. Rajat Gupta, former head of McKinsey, stood at the window, a glass of vintage Bordeaux in hand, yet his jaw tightened as he thought of the hedge fund titans with private jets and island estates. He'd earned tens of millions, but it wasn't enough, not when others had more. In The Psychology of Money, Morgan Housel's third lesson cuts deep. The pursuit of enough is a trap, a moving target fueled by comparison that can unravel even the most successful. No matter how much you have, the hunger for more can lead to ruin unless you define your own finish line. Housel begins with Gupta's story, a cautionary tale of greed's destructive pull. Gupta had it all: prestige, wealth, a legacy as a global business leader. But in the 2000s, rubbing shoulders with Wall Street's elite, he felt dwarfed. Billionaires like Goldman Sachs' Lloyd Blankfein set a new benchmark, and Gupta's millions seemed paltry by comparison. So, he crossed a line, engaging in insider trading to chase a bigger fortune. The result? A 2-year prison sentence, a $13.9 million fine, and a tarnished name. Housel asks, why risk everything when you're already set for life? The answer lies in the psychology of never enough. Social comparison, Housel explains, is a treadmill. There's always someone richer, flashier, or more powerful just ahead, goading you to keep running. This isn't just a Wall Street problem. Housel introduces the tech executive from earlier in the book, a man who epitomized excess. In the 1990s, flush with dot-com wealth, he threw gold coins into the Pacific Ocean for laughs, bought mansions, and lived like a rock star. But his spending spiraled, driven by a need to outshine his peers. When the tech bubble burst, so did his fortune. Bankruptcy followed, a stark reminder that chasing more without knowing enough leaves you vulnerable. Housel contrasts this with Ronald Read, the janitor who quietly amassed $8 million. Reed didn't compare himself to others. He lived simply, saved diligently, and found contentment in his modest life. His wealth grew because he knew what was enough for him. Housel digs into why enough is so elusive. Humans are wired to compare, a survival trait from our tribal days when status meant safety. Today, that instinct fuels envy in a world of Instagram yachts and Forbes lists. He cites research showing that happiness plateaus after a certain income, around $75,000 in 2010, adjusted for inflation. Yet people keep chasing higher numbers, thinking they'll feel secure. The tech executive's gold coins weren't about joy. They were about signaling he'd made it. Gupta's insider trading wasn't about need. It was about catching up to Blankfein. Both men fell into the same trap, measuring their worth against others, not their own values. The lesson's power lies in its call to action. Define your enough and stick to it. Housel shares a personal anecdote about his own temptation to upgrade his lifestyle after a financial windfall, only to realize that his family's modest needs, security, time together, were already met. He argues that wealth isn't about having the most, but about contentment with what you have. This means ignoring the neighbor's new Tesla or the colleague's vacation home. It means setting a financial goal that aligns with your life, not society's scoreboard. For Read, enough was a small house and a few stocks. For Gupta, no amount was enough, and it cost him everything. Housel's warning echoes through every lavish purchase and risky bet. The hunger for more is a fire that consumes unless you douse it with purpose. The tech executive's ocean of gold coins and Gupta's prison cell are stark reminders that enough isn't found out there, it's found within. Define it, guard it, and let the world chase its endless more. Lesson number 4. Confounding compounding. 96% of Warren Buffett's net worth came after his 65th birthday, at the time of the book's publishing. There are thousands of articles, books, and videos praising Warren Buffett for his investing genius, but nearly none focusing on the secret behind Warren Buffett's financial success: the power of long-term investing and compounding interest. The most important factor explaining his success is that he stuck with it. He remained invested for many decades and let the compounding do the heavy lifting. The takeaway is that successful investing is not just about high returns, but also about consistency and patience over time. It is about earning pretty good returns and about following a strategy you can stick with over a long period of time. In a quiet Vermont town, Ronald Red swept floors at a gas station, his worn broom scraping against the concrete as he saved nickels and dimes from his modest paycheck. Decades later, when he passed away at 92, the townsfolk gasped. This unassuming janitor had amassed $8 million, a fortune built not on flashy bets but on the quiet, relentless power of compounding. In The Psychology of Money, Morgan Housel's 4th lesson unveils the magic of compounding, a force so subtle it's easy to overlook, yet so potent it can turn small, consistent efforts into staggering wealth. But its secret lies in patience, a trait the world rarely celebrates. Housel starts with Reed's story, a masterclass in compounding's potential. Reed didn't win the lottery or strike it rich in tech. He simply saved a portion of his meager earnings, invested in blue-chip stocks like AT&T and Coca-Cola, and left them untouched for decades. By the time he died in 2014, his portfolio had snowballed, growing exponentially as dividends reinvested and stock prices climbed. Housel explains the math. At an 8% annual return, $1 becomes $2 in 9 years, $4 in 18, and over $14,000 in 100 years. Reed's wealth wasn't about picking the next big thing. It was about starting early, staying consistent, and letting time work its alchemy. His story isn't glamorous, but it's proof that compounding rewards the patient. Then there's Warren Buffett, the poster child for compounding's might. Housel notes that Buffett's $84 billion fortune, as of the book's writing, isn't just due to his investing genius, but his longevity. Buffett started investing at age 10, giving him over 80 years to let his returns compound. Housel crunches the numbers. If Buffett had begun at 30 and retired at 60, his wealth would be a fraction of what it is. The lesson? Time, not brilliance, is compounding's true driver. Buffett's early start and refusal to cash out early, unlike many who chase quick wins, made him a billionaire. Housel emphasizes that compounding isn't about making huge gains overnight. It's about modest, steady growth over years, even lifetimes. But compounding isn't just for the frugal or the famous. Housel shares a broader example, the U.S. stock market itself. From 1900 to 2019, the S&P 500 delivered an average annual return of about 6% after inflation. A $1 investment in 1900, left to compound, would be worth over $1,000 by 2019. That's not because every year was a winner, wars, depressions, and crashes battered markets, but because staying invested through the chaos allowed gains to build on gains. Housel contrasts this with the tech executive from earlier chapters, who squandered his dot-com millions on lavish spending. Had he saved even a fraction and let it compound, he might have avoided bankruptcy. Compounding punishes impatience as much as it rewards endurance. Housel digs into why compounding is so hard to embrace. It's slow, unglamorous, and demands discipline in a world obsessed with instant gratification. People crave big wins, lottery tickets, crypto moonshots, because small, steady steps feel insignificant. Yet, Housel argues, those steps are where wealth is born. He cites a study showing that most Americans don't invest at all, missing out on compounding's power because they can't wait or don't trust the process. Even those who invest often interrupt the magic, selling during downturns or chasing hot trends. Reed and Buffett succeeded because they ignored the noise, kept their money working, and let time do the heavy lifting. The lesson is a call to action. Start now, stay simple, and stick with it. Whether it's $10 a month in an index fund or a side hustle's profits in a savings account, compounding doesn't care about the amount. It cares about consistency and duration. Ronald Reed's Broom and Buffett's early stock picks remind us that wealth isn't about spectacle. It's about showing up day after day and trusting the quiet math of growth. In a world that screams for more, compounding whispers, be patient and you'll have enough. Lesson number 5. Staying wealthy is a different game than getting wealthy. The tech executive stood on the deck of his Malibu mansion, the Pacific Ocean glittering below, his dot-com millions fueling a life of gold coins tossed into the sea and parties that rivaled Hollywood premieres. But when the tech bubble burst in 2000, so did his fortune, his lavish lifestyle crumbling into bankruptcy. In The Psychology of Money, Morgan Housel's fifth lesson reveals a truth often ignored. Getting wealthy requires bold risks, but staying wealthy demands a different game, one of caution, humility, and a relentless focus on survival. The skills that build a fortune aren't the ones that keep it. Housel begins with the tech executive's downfall, a vivid example of how the traits that create wealth can destroy it. In the 1990s, his aggressive bets on tech stocks and fearless spending rode the dot-com wave to millions. But that same recklessness, chasing bigger risks, assuming the party would never end, left him exposed when the market crashed. He didn't just lose money. He lost everything, because he played the same high-stakes game to keep his wealth as he did to earn it. Housel argues that getting rich often involves optimism and risk-taking, like betting big on a startup or riding a market boom. Staying rich, however, requires a shift to defense, protecting what you have against life's inevitable shocks, market crashes, bad decisions, or plain bad luck. Contrast this with Ronald Reed, the Vermont janitor who quietly built an $8 million fortune. Reed's wealth wasn't born from daring moves, but from modest, consistent saving and investing in stable stocks over decades. His genius wasn't in getting rich, it was in staying rich. He lived frugally, drove a second-hand car, and avoided the temptation to chase bigger returns or flaunt his wealth. Housel points out that Reed's simplicity gave him room for error, a financial buffer that shielded him from market dips or unexpected expenses. While the tech executive's lifestyle left no margin for mistakes, Reed's humility and restraint ensured his wealth endured. Housel introduces another example, Richard Fuscone, a Harvard-educated financier whose story mirrors the tech executive's. Fuscone climbed the ranks at Merrill Lynch, earning millions and living large with a sprawling estate and luxury cars. But his heavy borrowing and risky investments unraveled during the 2008 financial crisis. He declared bankruptcy, his wealth vanishing because he didn't adapt to the game of preservation. Housel contrasts Fuscone with those who stay wealthy, like Warren Buffett, who combines aggressive investing with a paranoid focus on survival. Buffett keeps billions in cash reserves, not because he's timid, but because he knows markets are unpredictable. This balance, ambition tempered by caution, is what keeps wealth intact. The lesson hinges on a key concept. Survival is the foundation of staying wealthy. Housel emphasizes that wealth is fragile, vulnerable to overconfidence, debt, or external shocks. To protect it, you need a margin of safety, low debt, diversified investments, and enough cash to weather storms. He cites data showing that most financial disasters stem from over-leveraging, like Fuscone's borrowed millions, which amplify losses when things go wrong. Staying wealthy means planning for worst-case scenarios, even when the world feels safe. It's why Reed's frugal habits and Buffett's cash hoard are as critical as their investment choices. Housel's message is stark. The mindset that builds wealth can be your undoing unless you adapt. Getting rich might mean swinging for the fences, but staying rich means building a fortress. The tech executive and Fuscone fell because they never learned this. Ronald Reed thrived because he did, proving that wealth isn't just about making money. It's about keeping it through discipline and foresight. In a world that glorifies the climb, Housel reminds us, the real challenge is not falling off the mountain. Lesson number 6. The importance of tail events. In the summer of 1997, a young investor poured her savings into a fledgling online bookstore called Amazon, a speck in a sea of dot-com startups. 2 decades later, that bet transformed her modest stake into a fortune, as Amazon stock soared thousands of %. Meanwhile, Countless others who backed similar ventures watched their investments vanish when the tech bubble burst. In The Psychology of Money, Morgan Housel's sixth lesson unveils the power of tail events, rare, extreme outcomes that drive most financial returns. Success in investing often hinges on surviving long enough to catch these outliers, not on outsmarting the market every day. Housel begins by explaining that markets are dominated by a handful of extraordinary winners. He cites data showing that from 1980 to 2018, just 1.3% of U.S. companies accounted for nearly all the stock market's wealth creation. Giants like Apple, Microsoft, and Amazon, the tails of the distribution, delivered outsized gains that dwarfed the returns of thousands of others. But spotting these winners early is nearly impossible. In 1990s, for every Amazon, there were dozens of pets.coms that flopped spectacularly. Housel's point is that tail events are unpredictable, driven by chance as much as skill. The investor who backed Amazon wasn't necessarily a genius. She was persistent, holding a diversified portfolio long enough for one bet to pay off massively. Take the story of Ronald Read, the janitor whose $8 million fortune Housel revisits. Reed didn't chase hot stocks or time the market. He invested in safe, boring companies. Think Procter & Gamble and JP Morgan Chase, and held them for decades. His wealth wasn't come from picking the next Amazon, but from staying in the game, allowing compounding and the market's tail events to work their magic. By diversifying across many stocks and resisting the urge to sell during downturns, Reed increased his odds of capturing those rare winners that drive returns. Housel contrasts this with the tech executive who squandered his millions on reckless spending and risky bets. Had he diversified and waited, he might have caught a tail event, too, instead of going broke. Housel broadens the lens to history, citing the U.S. stock market's long-term growth. From 1900 to 2019, the S&P 500 grew about 6% annually after inflation, turning $1 into over $1,000. But that growth wasn't smooth. Tail events like the Great Depression, World War II, or the 2008 crash could have derailed investors who panicked and sold. Those who stayed invested, like Reed, reaped the rewards of rare, positive tails, tech booms, post-war recoveries, or companies like Apple reshaping the world. Housel emphasizes that markets reward endurance, not perfection. You don't need to predict the next big thing. You need to be there when it happens. The challenge, Housel notes, is human nature. We're drawn to action, picking stocks, chasing trends, because patience feels passive. Yet tail events require the opposite: diversification to spread your bets and discipline to avoid selling when markets tank. He references a study showing that most investors underperform the market because they jump in and out, missing the rare days when stocks surge. From 1990 to 2010, the S&P 500 returned 8% annually, but the average investor earned just 3% by trading too much. Staying put increases your odds of catching a tail, while overconfidence can knock you out of the game. The young investor who bought Amazon in 1997 didn't know it would become a juggernaut. She just held on, letting the market's chaos sort winners from losers. Housel's lesson is clear. Tail events, those unpredictable, outsized moments, shape wealth. To harness them, diversify, stay patient, and let time tilt the odds in your favor. In a world obsessed with control, success often comes from trusting the rare and random. Lesson number 7. Financial freedom is the ultimate goal. The financier strode through Wall Street, his tailored suit and Rolex signaling success. Yet his 80-hour weeks left him tethered to a desk, his life dictated by client calls and market swings. Across the country, Ronald Read, the Vermont janitor, lived in a modest home, drove a used car, and spent his evenings reading by a crackling fire, free to do as he pleased with his $8 million fortune quietly growing. In The Psychology of Money, Morgan Housel's 7th lesson cuts to the core. Financial freedom, the ability to control your time, is the ultimate goal of wealth. Money's true power isn't in buying things, it's in buying choices. Housel begins by redefining wealth as independence, not accumulation. The financier, despite his millions, was trapped, his high-flying lifestyle demanding constant work to sustain. His wealth bought mansions and private jets, but not the freedom to step away, to say no, or to live on his own terms. Housel contrasts this with Reed, whose frugal habits and diligent savings gave him something rarer: control. Reed didn't need to impress anyone or chase promotions. His $8 million, built through decades of investing in blue-chip stocks, meant he could wake up each day and choose how to spend it, whether volunteering, reading, or simply savoring a quiet morning. Housel argues that this is money's highest dividend: the power to do what you want, when you want, with whom you want. To illustrate, Housel shares a broader example: the growing desire for autonomy in modern life. He cites studies showing that happiness correlates more with control over one's schedule than with income beyond a modest threshold, about $75,000 in 2010, adjusted for inflation. A teacher earning $50,000 with summers off might feel freer than a CEO earning $5 million, but chained to board meetings. Financial freedom doesn't require billions. It requires enough to cover your needs without depending on a paycheck. Housel points to the FIRE movement, financial independence, retire early, where people save aggressively to retire in their 30s or 40s, not to stop working but to work on their own terms, starting passion projects, traveling, or raising families without financial stress. Reed, in his own way, embodied this, living simply to preserve his independence. Housel contrasts Red with the tech executive from earlier chapters, whose story underscores freedom's absence. Flush with .com cash in the 1990s, he spent wildly: gold coins tossed into the ocean, multiple homes, extravagant parties. But his lifestyle enslaved him to his wealth, requiring constant high-risk bets to maintain. When the tech bubble burst, so did his freedom, his bankruptcy stripping away not just his money but his choices. Had he saved and invested modestly, like Red, he might have bought the freedom to weather the crash and live as he pleased. Housel's point is stark: spending that chains you to earning more is the opposite of wealth. The lesson's heart lies in its call to prioritize time over stuff. Housel notes that humans crave freedom because it aligns with our deepest needs: autonomy, creativity, connection. Money amplifies this when used to simplify, not complicate, your life. He shares a personal reflection. After a financial windfall, he and his wife resisted upgrading their lifestyle, choosing instead to save and maintain flexibility. This gave them the freedom to take risks, like career changes, without fear of financial ruin. For Reed, freedom meant a life of quiet contentment. For others, it might mean traveling the world or starting a business. The key is building a financial buffer: savings, investments, low expenses, that lets you say yes to what matters. The financier's Rolex and the tech executive's mansions were mirages, glittering but binding. Ronald Reed's simple life was the real prize. Each dollar saved a step toward owning his time. Housel's lesson is a beacon: chase financial freedom, not flash, because the truest wealth is a life you control. Lesson number 8. Man in the Car Paradox. The sleek Ferrari roared down Rodeo Drive, its cherry red paint gleaming under the California sun, turning heads as passers-by whispered and pointed. Behind the wheel, a tech mogul grinned, certain his new ride signaled success, a trophy of his hard-won wealth. But the onlookers didn't admire him. They envied the car, imagining themselves in the driver's seat, their own dreams of status fueled by the sight. In The Psychology of Money, Morgan Housel's 8th lesson, The Man in the Car Paradox, reveals a subtle truth: flashy displays of wealth spark competition, not respect, and true wealth lies in what's unseen. Housel introduces the paradox with a simple observation: when you see someone in a fancy car, you don't think, "Wow, that person is successful." Instead, you think, "I want that car." The driver's attempt to project achievement backfires, igniting desire in others to outdo them rather than admire them. This dynamic, Housel argues, undermines the purpose of showing off. Wealthy people buy luxury goods, Lamborghinis, designer watches, sprawling estates, to signal their status, hoping for awe or approval. But the audience doesn't applaud. They chase the same symbols, perpetuating a cycle of one-upmanship that leaves everyone dissatisfied. Consider the tech executive from Housel's earlier chapters, who epitomizes this trap. In the 1990s, flush with .com millions, he threw gold coins into the Pacific Ocean, bought multiple mansions, and hosted extravagant parties, each purchase a loud declaration of his success. Yet, His peers didn't revere him. They scrambled to match or surpass his excess, buying bigger yachts or flashier cars. His displays didn't win admiration, but fueled a status arms race. When the tech bubble burst, his visible wealth vanished, revealing a deeper flaw. He'd spent to impress others, not to secure his future. Housel contrasts this with Ronald Read, the janitor who amassed $8 million quietly. Read drove a used Toyota and lived in a modest home, his wealth invisible in bank accounts and stock portfolios. No one envied him because no one knew. They just saw a humble man, free from the need to prove anything. Housel broadens the paradox to society at large, noting how social media amplifies it. In the Instagram age, people post photos of exotic vacations, luxury handbags, or private jets, hoping to project success. But followers don't think they're amazing. They feel pressure to keep up, scrolling through curated lives that spark envy, not inspiration. Housel cites research showing that materialistic pursuits, chasing visible wealth, correlate with lower happiness, as comparison steals contentment. The paradox is that the more you flaunt, the less you gain in respect, and the more you invite others to judge you by your possessions, not your character. The lesson's heart is a call to redefine wealth as what's hidden: savings, investments, and peace of mind. Housel argues that true wealth doesn't need an audience. It's the freedom to live without proving your worth. Read's fortune was powerful because it was private, giving him control over his life without the burden of others' expectations. The tech executive's Ferrari, meanwhile, was a shackle, tying him to a lifestyle he couldn't sustain. Housel shares a personal reflection. He and his wife keep their finances low-key, prioritizing security over status, knowing that a big house might impress neighbors but won't bring joy. The Ferrari's roar faded down Rodeo Drive, but its driver didn't win the admiration he sought, just a fleeting spotlight in a race no one truly wins. Housel's lesson is a quiet rebellion. Let wealth be your secret, not your billboard, because real success is living free from the paradox's glare. Lesson number 9. Wealth is what you don't see. The tech executive's mansion loomed over the California coastline, its glass walls framing a fleet of sports cars and a yacht bobbing in the distance, each purchase a glittering badge of success. Passers-by gawked, assuming he was the picture of wealth, until the tech bubble burst in 2000, and his empire of debt collapsed into bankruptcy. In The Psychology of Money, Morgan Housel's 9th lesson flips the script on what wealth means. It's not the cars, houses, or designer suits you see. It's the savings, investments, and discipline you don't. True wealth is invisible, a quiet power hidden in restraint. Housel opens with a stark contrast between appearances and reality. The tech executive's lavish spending screamed riches, but it was a mirage. His millions, earned in the dot-com boom, were poured into status symbols, leaving little in the bank. When the market crashed, he had no cushion, no unseen wealth to fall back on. Housel argues that we misjudge wealth because we equate it with what's visible. A big house or a Rolex looks like success, but often it's a trap, tying people to high expenses and fragile finances. Real wealth, he says, is the money you don't spend, the gap between what you earn and what you keep. Enter Ronald Read, the Vermont janitor whose $8 million fortune stunned his community. Read lived in a modest home, wore a threadbare coat, and drove a second-hand Toyota. To neighbors, he was just a frugal old man, maybe even struggling. But beneath the surface, Read was wealthy, not because he earned a lot, but because he saved relentlessly, investing in blue-chip stocks like Johnson & Johnson and letting them compound for decades. His wealth was invisible, locked in bank accounts and brokerage statements, not flaunted in possessions. Housel points out that Read's fortune gave him freedom, security, and options, the true markers of wealth, without needing to prove anything to anyone. Housel broadens the lesson with a societal lens, noting how we're conditioned to misread wealth. Social media and reality TV glorify spending, showcasing influencers with private jets or celebrities with diamond-encrusted watches. But Housel cites data showing that many high spenders are financially precarious. 40% of Americans can't cover a $400 emergency without borrowing, despite appearances. He contrasts this with the millionaires next door, a term from a famous study of unassuming people who amass wealth by living below their means. These are teachers, accountants, or small business owners with no flashy cars but hefty savings. Their wealth hidden in 401(k), S, or index funds. Like Red, they prioritize what's unseen over what's admired. The lesson's sting lies in its challenge. Stop judging wealth by what catches your eye. Housel shares a personal anecdote about meeting a man who drove a beat-up truck but owned a thriving business and a fat investment portfolio. The truck didn't signal poverty. It signaled discipline, a choice to keep wealth where it mattered. The tech executive, meanwhile, was a cautionary tale, as visible riches a house of cards. Housel argues that wealth is about options, retiring early, surviving a job loss, or funding a child's education, not about impressing strangers. Spending to look rich often means you're not, while saving quietly builds the real thing. As the tech executive's yacht was repossessed, Ronald Reed's unspent dollars grew silently, a fortune no one saw but everyone would envy if they knew. Housel's lesson is a wake-up call. Wealth isn't the shine of a sports car, it's the power of what's tucked away, ready to serve you when the world turns. Lesson number 10. Keep calm and focus on saving money. In the quiet of a Vermont morning, Ronald Reed sipped his coffee, tucked a few dollars from his janitor's paycheck into a savings account, and headed to work, his worn boots crunching on the gravel. Across the country, Richard Fuscone, a Wall Street titan, signed papers for another multi-million-dollar loan to fund his sprawling estate, confident his high-flying career would cover it. In The Psychology of Money, Morgan Housel's 10th lesson delivers a timeless truth. Saving money, not earning it, is the bedrock of financial security. Staying calm and prioritizing a high savings rate over flashy spending builds wealth that lasts. Housel opens with Reed's story, a testament to the power of saving. Earning a modest wage, Reed lived frugally, mending his clothes and driving a second-hand car. He saved a significant portion of his income, investing it in blue-chip stocks like Coca-Cola and letting them compound over decades. By his death in 2014, his savings had grown to $8 million, a fortune built not on a big salary, but on relentless discipline. Housel argues that saving is the one thing you control, unlike income, which can vanish in a layoff, or investments, which can tank in a crash. Reed's calm focus on saving gave him resilience, letting him weather economic storms without panic. Contrast this with Fuscone, whose tale Housel revisits as a cautionary counterpoint. A Harvard MBA and Merrill Lynch executive, Fuscone earned millions but spent even more, sinking his wealth into a lavish lifestyle, mansions, luxury cars, and private school tuitions. His high income fed a false sense of security, but heavy borrowing left him vulnerable. When the 2008 financial crisis hit, Fuscone's debts overwhelmed him, leading to bankruptcy. Housel points out that Fuscone's mistake wasn't just overspending, it was failing to save, to build a buffer against life's unpredictability. While Reed's savings were a shield, Fuscone's lack of them was a trap. Housel broadens the lesson with data, noting that savings rates matter more than income for long-term wealth. He cites studies showing that households with high savings rates, regardless of earnings, are more likely to achieve financial independence. A teacher saving 20% of a $50,000 salary builds more security than a CEO earning $1 million, but spending it all. Housel emphasizes that saving isn't about deprivation, it's about flexibility. Cash in the bank means you can survive a job loss, seize an investment opportunity, or retire early. He references the 40% of Americans who can't cover a $400 emergency without borrowing, a stark reminder that spending to keep up appearances often leaves you fragile. The tech executive from earlier chapters underscores this further. His dot-com millions fueled gold coins tossed into the ocean and extravagant parties, but he saved nothing. When the tech bubble burst in 2000, his lack of savings meant instant ruin. Had he saved even a fraction, like Red, he could have rebuilt. Housel stresses that saving requires calm, a rejection of societal pressure to spend on status symbols. He shares a personal note. He and his wife live below their means, not to hoard but to maintain options, knowing that savings buy peace of mind. Reed's coffee cooled as he saved another $1, each one a brick in his financial fortress. Fuscone's loans piled up, each one a crack in his foundation. Housel's lesson is a clarion call. Keep calm, save fiercely, and let the world chase its fleeting glitz. Your wealth will be the quiet kind that endures. Lesson number 11. Being reasonable works better than being rational. The spreadsheet glowed on Morgan Housel's screen, numbers neatly aligned, proving that keeping his mortgage at a low interest rate was the rational move. More money could be made investing elsewhere. Yet, as he sat with his wife in their cozy living room, the idea of paying it off felt right, a quiet promise of peace over profit. In The Psychology of Money, Housel's 11th lesson challenges the cold logic of finance. Being reasonable, aligning decisions with your emotions and values, often trumps being purely rational. Life isn't a math problem, and wealth is as much about sleeping well as stacking dollars. Housel starts with his own story, a rare personal glimpse. When he and his wife considered their mortgage, the data screamed to invest their extra cash in the stock market, where historical returns outpaced their loan's 3% rate. But the thought of debt, even cheap debt, nagged at them. They craved the freedom of owning their home outright, a buffer against life's uncertainties. So, they paid it off, not because it maximized wealth, but because it felt reasonable for their peace of mind. Housel argues that financial decisions aren't just about optimizing returns. They're about what lets you live comfortably with yourself. Reasonableness, he says, accounts for human quirks, fear, stress, joy, that spreadsheets ignore. Contrast this with the tech executive from earlier chapters, whose rational pursuit of wealth led to ruin. In the 1990s, he leveraged his dot-com millions into bigger bets, more stocks, more properties, because the math said markets would keep climbing. It was logical, given the boom's trajectory, but it ignored the emotional toll of risk and the unpredictability of bubbles. When the market crashed in 2000, his over-leveraged empire collapsed, leaving him bankrupt. Housel suggests that a reasonable approach, saving more, diversifying, accepting modest gains, might have saved him, not by being mathematically perfect, but by being emotionally sustainable. Housel broadens the lesson with Ronald Read, the janitor who amassed $8 million. Read's strategy wasn't rational by Wall Street standards. He didn't diversify broadly or analyze market trends. He bought familiar blue-chip stocks like AT&T and held them forever. A financial advisor might have called this naive, pushing for complex portfolios to optimize returns. But Read's approach was reasonable for him, simple, low stress, and aligned with his frugal nature. It worked because it fit his life, letting him save consistently without second-guessing. Housel cites studies showing that investors who stick to simple, emotionally comfortable strategies often outperform those chasing rational perfection, as they avoid costly mistakes driven by overthinking or panic. The lesson's power lies in its permission to prioritize feelings over formulas. Housel notes that finance glorifies rationality, maximizing every dollar, minimizing every cost, but humans aren't robots. A rational investor might stay fully invested during a crash to avoid missing a rebound, but a reasonable one might keep cash on hand for peace of mind, even if it costs potential gains. Housel references the 2008 financial crisis, when many rational investors, betting on quick recoveries, lost everything, while those who reasonably pulled back survived. Reasonableness, he says, builds resilience by respecting your limits. As Housel closed his laptop, the mortgage payment done, he felt lighter, not richer. The tech executive's spreadsheets had promised billions but delivered ruin, while Read's simple stock picks built a quiet fortune. Housel's lesson is a gentle rebellion. Be reasonable, not rational, and choose the path that lets you breathe easy, even if the numbers don't cheer. Lesson number 12. Expect surprises along the way. The trading floor buzzed with confidence in September 2008, brokers shouting orders as screens flashed green, oblivious to the storm brewing beneath Wall Street's surface. Within days, Lehman Brothers collapsed, triggering a global financial crisis that no one, analysts, CEOs, or investors, saw coming. In The Psychology of Money, Morgan Housel's 12th lesson is a stark reminder. The financial world is a land of surprises, where the unexpected shapes outcomes more than any forecast. To thrive, you must expect the unpredictable and build plans that bend, not break, when shocks arrive. Housel opens with the 2008 crisis, a textbook surprise that upended lives and portfolios. Markets had soared for years, fueled by easy credit and housing mania, and experts dismissed warnings as noise. But when subprime mortgages unraveled, the dominoes fell, wiping out trillions in wealth. Housel argues that history is littered with such shocks, events no one predicted but everyone later claimed were obvious. He cites the dot-com crash of 2000, when tech stocks, deemed unstoppable, plummeted, ruining the tech executive from earlier chapters who bet everything on the boom. These surprises aren't anomalies. They're the norm in a complex world where countless variables collide. Consider Ronald Read, the janitor whose $8 million fortune weathered decades of chaos. Read didn't try to predict markets or dodge crashes. He saved diligently, invested in stable stocks like Procter & Gamble, and held on through Black Monday in 1987, the 2008 crisis, and more. His secret? Expecting surprises and preparing for them with simplicity and resilience. Housel notes that Read's frugal lifestyle and diversified portfolio gave him room for error, a buffer against the unexpected. When markets tanked, he didn't panic or sell. He stayed calm, knowing shocks were part of the game. His wealth grew because he planned for the unknown, not because he outguessed it. Housel contrasts Read with Richard Fuscone, the Wall Street financier whose story underscores the cost of ignoring surprises. Fuscone's millions, earned at Merrill Lynch, funded a lavish life built on heavy borrowing and concentrated bets. He assumed his income and the market's rise were permanent, leaving no margin for error. When the 2008 crisis hit, his over-leveraged empire crumbled, leading to bankruptcy. Housel points out that Fuscone's downfall wasn't just bad luck. It was a failure to expect the unexpected. High debt and low savings left him brittle, unable to absorb the shock that history guaranteed would come. Housel broadens the lesson with historical data, showing how surprises define markets. He references the S&P 500's long-term 6% annual return after inflation from 1900 to 2019, a steady climb pocked with chaos. 2 world wars, the Great Depression, recessions, and pandemics. No one predicted these events, yet investors who stayed diversified and liquid, like Read, survived and thrived. Housel cites a study showing that most market gains come from a few unpredictable days, meaning those who sell during surprises miss the rebounds. Planning for shocks, keeping cash reserves, avoiding debt, spreading bets, keeps you in the game when others are knocked out. The lesson's heart is a call to embrace uncertainty. Housel argues that forecasts are flimsy, as the world is too complex for anyone to master. Instead of betting on predictions, build flexibility, save more than you need, invest broadly, and live below your means. He shares a personal note. He keeps extra cash, not for returns, but for the peace of knowing he can handle whatever comes. The 2008 traders and Fuscone learned the hard way. Surprises don't announce themselves. Ronald Read's quiet fortune proved the wiser path. Expect the unexpected, and you'll be ready when it arrives. Lesson number 13. Leave some room for error. The Wall Street office gleamed with polished mahogany, where Richard Fuscone, a Merrill Lynch executive, signed off on another loan to fuel his lavish Connecticut estate, certain his millions would keep flowing. Across the country, Ronald Read mended his old coat in his modest Vermont home, his bank account padded with extra savings from his janitor's paycheck, ready for whatever life might throw. In The Psychology of Money, Morgan Housel's 13th lesson is a lifeline for navigating an unpredictable world. Leave room for error. Building a financial buffer, through savings, low debt, and conservative plans, keeps you standing when mistakes or surprises strike. Housel begins with Fuscone's fall, a stark warning of what happens without a margin of safety. Fuscone, a Harvard MBA, earned millions but lived on the edge, borrowing heavily for mansions, private schools, and luxury cars. His financial plan assumed his income and the market's rise were unshakable, leaving no wiggle room for error. When the 2008 financial crisis hit, his over-leveraged life unraveled, plunging him into bankruptcy. Housel argues that Fuscone's collapse wasn't just bad luck, it was a lack of buffer. High debt and zero savings meant one misstep, one surprise, could wipe him out. A single error, amplified by no margin, turned wealth into ruin. Contrast this with Ronald Read, whose $8 million fortune was a masterclass in room for error. Read earned little but saved much, living far below his means in a small house with a used Toyota. His investments in blue-chip stocks like Coca-Cola were diversified, not flashy, and he kept enough cash to handle emergencies. When markets crashed, like in 1987 or 2008, Reed didn't need to sell at a loss or borrow to survive. His frugality and savings gave him a cushion, letting him ride out storms that sank others. Housel emphasizes that Reed's wealth endured not because he was a genius, but because he planned for the inevitable, life's mistakes, market dips, or unexpected bills. Housel broadens the lesson with the tech executive, whose dot-com millions vanished in the 2000 crash. His gold coins tossed into the ocean and sprawling mansions left no savings, no room for error. When tech stocks plummeted, he had nothing to fall back on, his reckless spending exposing him to ruin. Housel contrasts this with data on market history. The S&P 500's 6% annual return from 1900 to 2019 came with brutal drops. 50% in the Great Depression, 40% in 2008. Investors who survived had buffers, cash, diversified portfolios, low expenses, while those stretched thin, like Fuscone or the tech executive, broke. Housel cites studies showing that over-leveraging causes most financial disasters, as debt magnifies errors into catastrophes. The lesson's core is practical. Build resilience by expecting the worst. Housel advocates for conservative financial plans, keeping 6 to 12 months of expenses in cash, avoiding heavy debt, and investing broadly to spread risk. He shares a personal note. He holds more cash than rational models suggest, not for returns, but for flexibility when life surprises. Room for error isn't about fear, it's about staying in the game. Fuscone's loans and the tech executive's extravagance left them brittle, while Reed's savings made him anti-fragile, thriving through chaos. As Fuscone's estate was auctioned off, Reed's quiet savings grew, a shield against the world's curveballs. Housel's lesson is a quiet command. Leave room for error, because in money, as in life, the unexpected isn't just likely, it's certain. Lesson number 14. Remember the end of history illusion. In the heart of Silicon Valley, a young coder in his 20s poured his savings into volatile tech stocks, convinced his appetite for risk would define his life forever. Meanwhile, in Vermont, Ronald Redd, now in his 80s, smiled as he stuck to his steady blue-chip investments, content with the safety he'd come to value over decades. In The Psychology of Money, Morgan Housel's 14th lesson unveils the end of history illusion, the human tendency to believe who we are now, your goals, desires, and priorities, will remain unchanged forever. Embracing the reality that you'll change is key to crafting a flexible financial plan that grows with you, not against you. Housel introduces the concept through psychological research by Daniel Gilbert, who coined the term. The illusion tricks us into thinking our current self is the final version, underestimating how aging, experiences, and life's twists reshape our values. A 25-year-old might crave the thrill of high-risk crypto trades, assuming they'll always chase big wins, but by 35, with a family and a mortgage, they may crave stability. Housel argues that financial plans often fail when we lock ourselves into rigid strategies based on today's desires, ignoring the person we'll become. Flexibility, not certainty, is the antidote. Take the young coder, a fictional stand-in for the tech executive from Housel's earlier chapters. In the 1990s, flush with dot-com cash, he bet heavily on tech stocks and real estate, his aggressive style matching his youthful ambition. It felt right. He was a risk-taker, and always would be, or so he thought. But when the 2000 crash wiped out his fortune, he faced a humbling shift. Older, battered by loss, he craved security, regretting his all-in bets. Housel suggests the executive fell victim to the end of history illusion, assuming his 20s self would never evolve. A more flexible plan, saving some cash, diversifying beyond tech, might have served both his young and future selves. Contrast this with Ronald Redd, the janitor whose $8 million fortune reflected a life of adaptability. In his younger years, Reed likely took modest risks, buying stocks like AT&T when they were less certain. But as he aged, his priorities shifted to preservation, favoring stable companies and a frugal lifestyle. Housel notes that Reed's strategy wasn't rigid. He didn't chase trends or cling to a single stock. His diversified portfolio and high savings rate gave him room to adjust as his needs changed, from building wealth to protecting it. Reed's success wasn't just discipline. It was flexibility, avoiding the illusion that his younger self knew best. Housel broadens the lesson with a societal example, the shifting financial landscape. In the 1980s, young investors rode the stock market's rise, assuming it defined their future. But by the 2000s, after dot-com and housing crashes, many pivoted to safer assets like bonds or real estate, their risk tolerance reshaped by experience. Housel cites data showing that investor behavior changes with age. Younger people favor growth stocks, while older ones lean toward dividends. Those who planned for this shift, like Red, thrived. Those who didn't, like the tech executive, stumbled. The illusion, Housel warns, makes us overcommit to strategies that won't suit our future selves. The lesson's call is clear: build financial plans with room to evolve. Housel advocates avoiding extreme decisions, all-in stock picks, heavy debt, or zero savings, that lock you into one path. Instead, diversify, save aggressively, and keep cash for flexibility. He shares a personal note. He invests in index funds, not because they're perfect, but because they suit any version of his future self. The coder's crypto bets and the tech executive's leverage ignored their inevitable change. Reed's quiet discipline embraced it. As the coder refreshed his trading app, Ronald Reed checked his modest portfolio, both men unaware of who they'd become. Housel's lesson whispers: plan for the person you'll be, not just the one you are, because change isn't coming, it's certain. Lesson number 15. Nothing is free. There's always a cost to investing. The stock ticker flickered on the young trader's screen, his heart racing as he dove into a hot tech IPO, dreaming of quick riches in the 1990s dot-com frenzy. But when the bubble burst in 2000, his portfolio crumbled. The price of his impatience paid in sleepless nights and wiped out savings. In The Psychology of Money, Morgan Housel's 15th lesson delivers a hard truth. Nothing in investing is free. Every gain comes with a cost: volatility, uncertainty, or emotional strain. And success hinges on willingly paying that price while staying in the game. Housel opens with the tech executive, whose story weaves through the book as a cautionary tale. Flush with millions from the dot-com boom, he chased sky-high returns, piling into tech stocks and real estate with no regard for risk. The cost? Crushing volatility. When the market crashed in 2000, his concentrated bets and lavish spending, gold coins tossed into the ocean, multiple mansions, left him bankrupt. Housel argues that the executive ignored investing's price. Markets don't hand out rewards without testing your resolve. High returns demand enduring, gut-wrenching drops, and he wasn't ready to pay. Contrast this with Ronald Reed, the Vermont janitor whose $8 million fortune grew quietly over decades. Reed invested in steady blue-chip stocks like Johnson & Johnson, accepting the cost of modest returns for stability. The price he paid was patience, foregoing flashy gains for slow, consistent growth, and emotional discipline, holding through crashes like 1987's Black Monday or the 2008 crisis. Housel notes that Reed's success came from embracing these costs, never panicking or chasing quick wins. His frugal life and diversified portfolio meant he could afford to wait, letting compounding work while others bailed during downturns. Housel broadens the lesson with market history, emphasizing that investing's costs are universal. He cites the S&P 500's 6% annual return after inflation from 1900 to 2019, a solid gain that came with brutal tolls: 50% drops in the Great Depression, 40% in 2008, and countless smaller dips. The price of those returns was enduring fear, doubt, and the temptation to sell at the worst times. Housel references a study showing that from 1990 to 2010, the S&P 500 returned 8% annually, but the average investor earned just 3% because they fled during volatility, unwilling to pay the emotional cost of staying invested. Those who thrived, like Reed, accepted the market's turbulence as the entry fee for long-term gains. The lesson's sting lies in its challenge. You must stomach investing's price or miss its rewards. Housel argues that every strategy has a cost. Stocks bring volatility, bonds offer low returns, cash erodes to inflation. Even safe investments like treasury bonds carry opportunity costs, as money parked there misses stock market growth. He shares a personal reflection. He invests in index funds, accepting the cost of average returns for simplicity and peace of mind. The tech executive's ruin came from seeking free riches, dodging the market's tests. Reed's wealth grew because he paid the price of patience daily. As the trader's screen went red in 2000, Ronald Reed's portfolio dipped but held. His calm acceptance of investing's costs a quiet triumph. Housel's lesson is a sober reminder. Nothing is free. Pay the price of volatility, doubt, or time, and the market may reward you, but only if you're willing to stay. Lesson number 16. Which game are you playing? In a bustling Silicon Valley cafe, a young entrepreneur hunched over her laptop, eyes fixed on stock charts, chasing the adrenaline of day trading crypto to score quick millions. Across the country, Ronald Reed sat quietly in his Vermont home, reviewing his modest portfolio of blue-chip stocks, content with slow, steady growth that secured his simple life. In The Psychology of Money, Morgan Housel's 16th lesson poses a critical question. Which game are you playing? Financial decisions are shaped by personal values and goals, not universal rules, and success depends on aligning your strategy with the game that suits you. Housel begins by emphasizing that money decisions are deeply personal, forged at the dinner table as much as in boardrooms. The entrepreneur's game was high-stakes speculation, driven by her ambition to strike it rich fast in a booming tech world. Her strategy, pouring savings into volatile assets like Bitcoin, fit her risk tolerance and dreams of a big payoff, but it came with sleepless nights and wild swings. Housel doesn't judge her choice. He argues that what works for one person can be disastrous for another. The key is knowing your game, your goals, temperament, and timeline, and sticking to it, rather than copying someone else's playbook. Ronald Reed played a different game, one of patience and simplicity. As a janitor, he earned little but saved much, investing in stable companies like Procter & Gamble and holding them for decades. His goal wasn't to outsmart Wall Street or flaunt wealth. It was financial security and independence. By his death in 2014, his $8 million fortune proved his game worked for him. Housel notes that Reed's strategy, rooted in his frugal values and long-term horizon, would have stressed out the entrepreneur, just as her high-risk bets would have kept Reed awake at night. The lesson? There's no one-size-fits-all in finance. Your game must match your life. Housel contrasts these with the tech executive, whose story underscores the peril of playing the wrong game. In the 1990s, he chased the dot-com boom's promise of endless growth, leveraging his millions into tech stocks and real estate, driven by a need to signal success. His game was status, not wealth building, and it led to reckless spending, gold coins tossed into the ocean, sprawling mansions that left no savings. When the 2000 crash hit, his bankruptcy revealed he'd been playing a game misaligned with his reality, copying the flashy moves of peers without considering his own needs. Housel suggests a simpler game, like Reed's, could have saved him, focusing on savings and resilience over spectacle. Housel broadens the lesson with a societal lens, noting how cultural and personal contexts shape our games. He cites data showing varied investor behaviors. Young urban professionals might favor aggressive growth stocks, while retirees lean toward bonds for stability. Neither is right. They're different games, tied to life stages and values. Housel references the 2008 financial crisis, where those playing the get-rich-quick game, like the tech executive, often lost everything, while those playing for security, like Reed, weathered the storm. Understanding your game, whether it's early retirement, funding a child's education, or building a legacy, guides your choices, from saving rates to risk tolerance. The lesson's heart is a call to self-awareness. Housel urges readers to define their game by asking, "What do I want, and what can I live with?" He shares a personal note. He plays a game of independence, prioritizing low-cost index funds and high savings to maintain flexibility, not to maximize returns. The entrepreneur's crypto trades and the tech executive's leverage failed because they didn't match their true goals or ignored the emotional toll. Reed's quiet discipline won because it fit his life like a glove. Lesson number 17. Pessimism is attractive. The newsroom buzzed with urgency in 2008, anchors grimly forecasting economic collapse as the financial crisis unfolded, their dire warnings gripping viewers who hung on every word. Meanwhile, Ronald Reed, in his quiet Vermont home, ignored the headlines, calmly holding his blue-chip stocks through the chaos, his $8 million fortune weathering the storm. In The Psychology of Money, Morgan Housel's 17th lesson reveals why pessimism captivates us. It feels smart, urgent, and safe, but its allure can derail financial success. Optimism, though less glamorous, often aligns better with the long-term reality of progress. Housel begins by explaining pessimism's magnetic pull. Bad news, like market crashes or recessions, grabs attention because it triggers our survival instincts, demanding immediate action. In 2008, as Lehman Brothers fell, pundits predicted decades of ruin, and investors panicked, selling at market lows. Housel notes that pessimism sounds profound, as if it sees through the world's flaws, while optimism seems naive, even reckless. Yet, history shows that markets recover. Those who sold in 2008 missed the S&P 500's rebound, doubling in value by 2013. Pessimism's loud warnings feel wise, but often cost more than they save. Ronald Read's story is a quiet counterpoint. As a janitor, he faced countless crises: Black Monday in 1987, the dot-com crash, and 2008's meltdown, but never succumbed to doom-laden headlines. His game was long-term optimism, investing in companies like Coca-Cola and holding them for decades. Housel argues that Read's success wasn't blind faith, but a realistic belief in progress. Economies grow, companies innovate, and markets, despite stumbles, trend upward. By ignoring pessimism's siren call, Read let his wealth compound, turning modest savings into millions. His optimism wasn't flashy, it was disciplined, trusting time over panic. Contrast this with the tech executive, whose tale Housel revisits as a victim of pessimism's trap. In the 1990s, he rode the dot-com wave, but when whispers of a bubble grew in 1999, he doubled down, fearing he'd miss out. Then, as pessimism took hold in 2000's crash, he sold at the bottom, spooked by apocalyptic forecasts. His erratic moves, chasing hype, then fleeing in fear, left him bankrupt. Housel suggests that a steadier, optimistic approach, like Read's, would have let him weather the crash and recover. Pessimism's urgency pushed the executive to act at the worst moments, proving its cost. Housel broadens the lesson with data, highlighting why optimism wins over time. From 1900 to 2019, the S&P 500 delivered a 6% annual return after inflation, despite wars, depressions, and pandemics. Pessimists who bailed during downturns missed this growth, as fear overstated risks. Housel cites a study showing that markets spend more time rising than falling. 70% of years since 1928 were positive. Yet, bad news dominates, with media amplifying crises because they sell. Pessimism feels prudent, but it blinds us to the quiet reality. Progress, though uneven, persists. The lesson's heart is a call to balance. Housel isn't advocating blind optimism. Prepare for downturns with savings and diversification, but warns against letting pessimism dictate your moves. He shares a personal note. He invests with an eye on long-term growth, accepting short-term dips as part of the ride. The 2008 anchors and the tech executive fell for pessimism's drama. Read's quiet faith in the future built a fortune. Housel's message is clear. Pessimism may seduce, but optimism, tempered with patience, is the surer path to wealth. Lesson number 18. Be careful about what you believe. The financial news blared across the young investor's screen in 1999, touting tech stocks as a sure path to riches, each headline fueling his conviction that the dot-com boom would never end. He poured his life savings into Pets.com, certain of its unstoppable rise, only to watch it collapse in the 2000 crash, his dreams shattered by a belief that felt ironclad. In The Psychology of Money, Morgan Housel's 18th lesson is a sharp warning. Be careful about what you believe. Financial beliefs, often shaped by stories and biases, can lead you astray unless you question them with rigor and humility. Housel opens by exploring why beliefs about money are so powerful and so dangerous. We cling to narratives that feel true, like the dot-com investor's faith in a new economy where profits didn't matter. This belief wasn't random. It was fueled by media hype, peer enthusiasm, and the era's euphoria, creating a story that seemed undeniable. Housel argues that financial beliefs are less about facts and more about what we want to be true, shaped by our experiences and environment. The investor's mistake wasn't just bad timing. It was failing to challenge a seductive narrative that clouded his judgment. Ronald Read, the Vermont janitor, offers a counterpoint. With his $8 million fortune, Read ignored the noise of market fads, sticking to a simple belief: save diligently, invest in stable companies like AT&T, and let time do the work. His conviction wasn't based on flashy trends or guru predictions, but on a grounded understanding of compounding and discipline. Housel notes that Read's success came from questioning popular beliefs, like the need to chase hot stocks, and trusting a strategy that matched his reality. When others believed in quick riches during the 1990s boom or panicked in the 2008 crisis, Read stayed steady, his skepticism of hype preserving his wealth. Housel contrasts Read with the tech executive, whose story recurs as a cautionary tale. In the 1990s, he believed the dot-com rally was permanent, a narrative reinforced by his peers' success and Wall Street's cheerleading. He leveraged his millions into tech stocks and real estate, convinced he'd cracked the code to endless wealth. When the 2000 crash hit, his belief crumbled, leaving him bankrupt. Housel suggests his downfall stemmed from blind faith in a story, tech's invincibility, without testing it against history or risk. A dose of doubt, like Read's, might have prompted diversification or savings, softening the blow. Housel broadens the lesson with historical examples, showing how beliefs shape markets. He cites the 2008 financial crisis, driven by a widespread conviction that housing prices could never fall. Homebuyers, bankers, and regulators bought into this story, ignoring data on past bubbles. When reality hit, trillions in wealth vanished. Housel references studies showing that investors often overestimate their knowledge, clinging to beliefs, like market timing or stock-picking prowess, that don't hold up. From 1990 to 2010, the S&P 500 returned 8% annually, but the average investor earned 3%, swayed by flawed convictions that led to bad trades. The lesson's core is a call to question your financial beliefs. Housel urges skepticism toward gurus, headlines, and even your own instincts, testing them against evidence and long-term patterns. He shares a personal note. He challenges his own investment choices, favoring index funds not because they're trendy, but because they've historically worked. The young investor's pets.com bet and the tech executive's leverage fell to unexamined beliefs. Read's quiet fortune grew from a belief he'd vetted through discipline and time. As the investor mourned his losses in 2000, Ronald Read checked his portfolio, his simple belief in saving and patience unshaken. Housel's lesson is a quiet plea. Question what you believe, because in money, as in life, the stories you trust shape your fate. The Psychology of Money is more than a finance book. It's a guide to understanding how behavior, emotion, and mindset shape our financial outcomes. The main theme is simple yet powerful. Managing money well isn't about intelligence, it's about behavior. If you want to build wealth, reduce stress, and feel in control of your financial future, this book is worth reading. These nearly 20 lessons from Morgan Housel's work can reframe your relationship with money and help build long-term financial peace of mind. The key message is that true financial success is grounded in mastering basic but powerful habits, saving consistently, being patient, and avoiding emotional decisions. These are the real lessons about money that last a lifetime. Whether you're seeking a quick summary or wondering if the psychology of money is worth it, the answer is yes. It delivers practical, life-changing insights in a way that's both relatable and timeless. Have you read The Psychology of Money, or can you recommend an equally impactful book to other readers? Share with us your biggest takeaway in the comments.